The mortgage was almost approved. The inspection had passed. John and Sarah were close enough to picture themselves at the closing table. Then the homeowner's insurance quote came back, thousands of dollars higher per year. That one number changed the whole math. The monthly payment no longer worked. The debt-to-income ratio crossed the red line. The house was still there. Their income was still there. But the lender said the loan could not close without acceptable insurance. The seller had not backed out. Their credit score had not collapsed. The house did not suddenly have a cracked foundation or a failing roof. They could afford the mortgage. But the insurance market looked at that address and said, "This risk is too expensive to take." A few hours earlier, they were picturing where the sofa would go. They were thinking about the color of their child's room. They were imagining a small barbecue in the backyard. Now, all of that was stuck behind one insurance quote. This is the new version of the American dream. You can have enough money to buy the house and still not get the keys, because another market just locked the front door. And this is not just a story about a failed home purchase. This is a trap with a very comforting name: insurance of last resort. The scary part is not just that the bill goes up. When the private insurance market says no, John and Sarah cannot simply walk to the next counter. If they have a mortgage, they still need insurance. Without it, the house is no longer just a dream. It becomes an incomplete file in the eyes of the bank. This is the last resort home trap. On the surface, it looks like the final safety net for homes the traditional insurance market does not want to cover. In California, the name many homeowners hear is the FAIR Plan. In Florida, many homeowners know Citizens Property Insurance, usually just called Citizens. It sounds like a life raft, but that life raft can be more expensive. It can be thinner, and it can still require you to buy extra pieces of protection somewhere else. Here is what many buyers do not see. Being insured does not automatically mean being protected. Sometimes it only means the bank is temporarily satisfied. And if that is all the policy buys you, the first reversal has only begun. Back to John and Sarah. After that call, they do what many Americans would do. They call the broker. They send more emails. They try a few more carriers, but the broker sighs. The private market has backed away from that address. The remaining option is the FAIR Plan. At first, its name sounds almost reassuring. Fair sounds fair. Plan sounds like somebody has a plan. John and Sarah tell themselves, at least there is still a state-backed safety net. But when the quote arrives, that feeling starts to crack. Their old policy was around $2,000 a year. Now the number can jump to $6,000, and the worst part is this. They are not paying more for a fuller policy. A FAIR Plan policy may give you enough basic coverage to keep the lender from rejecting the file. But everyday things like water damage, theft, liability, or the cost if someone gets hurt in your home may require another policy on top of it. That extra layer is called a difference in conditions policy, or DIC. The old policy used to feel like one roof. Now the system sells the roof back in shingles. One piece from the state plan. One piece from the private market. One piece to make the bank comfortable. And after all of that, John and Sarah still do not know if their family is truly protected. They are not paying more to sleep better. They are paying more to keep the mortgage alive. And if you think paying more must mean being more protected, the next lawsuit breaks that illusion open. At this point, you might think, fine, the FAIR Plan is expensive, the coverage is thinner. But if a wildfire actually happens, at least it has to pay, right? If smoke fills the house, if ash gets into the ventilation system, if the smell of fire sinks into the walls and carpet, that is clearly damage from fire. But this is where the story turns colder. Imagine a family surviving a wildfire. The house does not burn to the ground. The walls are still standing. The roof is still there. From the outside, it still looks like a house. But inside, the air smells burned. Smoke particles and ash have moved into places the eye cannot see. The living room is still there, but it no longer feels safe. Then the claim goes in. The answer that comes back is not, we will help clean the home. The answer is, this damage does not qualify under the way the policy defines damage. That is why the J. Aleph case against the California FAIR Plan matters. The dispute was not just about a payout. It was about a colder question. Who gets to define damage after you have already paid to be protected? According to reporting on the case, a California court found that certain limits in how the FAIR Plan handled smoke damage were unlawful. The court found that those limits narrowed coverage beyond what buyers of a fire policy could reasonably expect. That is the reversal. The trap is not only that you pay too much. The trap is that you may pay too much for a contract where every word can become a battlefield. The smoke got into the house, but the loophole got into the policy. And when the policy disappears completely, the next person in the room is not the insurer. It is the lender. John and Sarah are no longer just talking to a broker. They are talking to the bank. And the bank is not asking, is your family protected? The bank is asking a colder question. Is the loan protected? A month later, the mortgage payment does not look like last month's payment. John opens the escrow statement and sees a line that sounds like a system error. Lender-placed insurance. Another name is even more direct. Force-placed insurance. They did not choose it. They did not compare prices. The servicer saw that the home no longer had the required policy. Then it placed insurance for them and pushed the cost into the monthly payment. This is the moment the trap locks. Force-placed insurance can be more expensive than a normal homeowner's policy. But it is not always designed like full armor for the family. It is placed first to protect the lender's interest in the property securing the mortgage. You may be the one paying the bill, but the first person being reassured is not you. It is the loan. The child's room is yours. The sofa in the living room is yours. The boxes in the garage are part of your life. But the new policy may not protect those things in the way you imagine. It may care more about the debt still sitting on the house. I call this the hostage tax. You are not paying because you wanted peace of mind. You are paying because your home is being held hostage by the terms of the mortgage. Force-placed insurance does not walk in to save you. It walks in to protect the bank from the risk you represent to the loan. But the bank is not the only layer that can move you around. In Florida, even the state safety net can open another door. And that door can send you back into the private market through a 20% rule. In Florida, the trap has a name that sounds like it belongs in a conference room. Depopulation. It sounds technical, neutral, almost like someone is cleaning up a spreadsheet. But to a homeowner, it can feel like this. You run into the safety net because the private market left you behind. Then the safety net sends you back into the private market. Citizens is Florida's insurer of last resort. When too many homes cannot find coverage, Citizens grows. On paper, reducing Citizens is not irrational. If a private company is willing to take the risk back, the state wants that policy out before hurricane season. But to the homeowner, it does not feel like clean math. It feels like a letter in the mailbox. A company they did not choose, a small deadline near the bottom of the page. Under the 20% rule, if a private insurer offers a premium that is not more than 20% higher than the estimated Citizens renewal premium, the homeowner may no longer be eligible to stay with Citizens. Coverage can move to the new insurer when the current policy ends. A homeowner like Scott Bassett sees changing estimates and a new company name suddenly entering his financial life. Nobody says, "We found you a better option." They say he has been depopulated. It sounds like a human being has been turned into a line of risk data. Here is the reversal. The safety net is not necessarily designed to hold you forever. It may only hold you long enough for the market to price you again. But if we stop at insurance companies are just greedy, the story becomes too easy. The coldest part is that they have a real reason, and that reason makes the trap more frightening. If you are thinking, so the insurance companies are just being greedy, that sentence feels good. But it is not enough. It is easier to watch and less true. Insurance is not magic. It is risk math. An insurance company collects premiums from millions of people. Then it uses that money to pay claims when homes burn, hurricanes tear off roofs, or wildfire moves through an entire neighborhood. If the money going out rises faster than the money coming in, the math starts to crack. The coldest part is that the model does not need to hate John and Sarah. It does not need to know they never filed a claim. It looks at the zip code, the wildfire map, the age of the roof, the rebuilding cost, and the cost of reinsurance. Then it reaches a conclusion. This risk no longer looks good on the balance sheet, so no. Every price increase is not automatically irrational. Some of it comes from severe weather, rebuilding costs, and reinsurance. Insurance companies also have to buy insurance for themselves. When the upper layer gets more expensive, the layer below tightens. But this is where it hurts. The insurer can leave a region, the reinsurer can raise prices, the bank can add conditions, the state plan can reduce its exposure. The homeowner cannot leave the kitchen, the child's room, or the mortgage as easily as a line on a spreadsheet. When every layer above you has a way to push risk downward, the question is this: who is standing at the bottom? This is where the story leaves John and Sarah's mailbox and moves up a level. Because a home insurance bill does not swell in a vacuum, it travels through a risk food chain. The homeowner buys insurance, so the bank will allow the mortgage to stay in place. But the insurer does not want to stand alone against wildfire, hurricane, hailstorm, or an entire neighborhood burning at once. So the insurer buys reinsurance. In simple terms, the insurance company buys insurance for itself. When disasters become more expensive, the reinsurance layer raises prices or tightens terms. The primary insurer looks down at high-risk zip codes and recalculates. Some raise premiums. Some stop renewing. Some leave the area. And when they leave, the homeowner does not get to step out of the system. The homeowner gets pushed to the next layer. The FAIR Plan, Citizens, or another last resort program. But state plans are not bottomless wells. When too many homes get pushed into them, the risk grows. Premiums rise, depopulation appears. Coverage gets divided. And if the policy slips out of the homeowner's hands, the lender steps in with force-placed insurance. What do John and Sarah have? They do not have a catastrophe modeling team. They do not have the power to exit a zip code through a board meeting. They have a kitchen, a child's room, an escrow statement, and a checking account where the final shock lands. That is the risk food chain. From climate to reinsurance, from reinsurance to insurer, from insurer to state plan, from state plan to escrow. And finally, from escrow to the checking account of an American family trying to keep a home. The disaster may start on a weather map, but it ends in a family's checking account. The system is not simply broken. It protects the layers that have the power to retreat first. The homeowner has the least room to retreat. So the homeowner becomes the final shock absorber. And when you are the final shock absorber, what you lose is not just money. What you lose is the feeling that the house truly belongs to you. This is where the anger should slow down. If this is happening to you, it does not mean you were careless, lazy, or bought too much house. You may have done everything American life told you to do. Keep a good credit score. Save for the down payment. Pay the mortgage on time. Never file a claim. But the system can still change the rules after you are already inside. You have the keys. You have the paperwork. You have the mortgage statement with your name on it. But a risks model, an insurer, or a lender can still decide what it costs for you to stay. That is the illusion of ownership. The crisis does not always begin with a wildfire. It can begin with a thin envelope in the mailbox, a notice of non-renewal, or a renewal quote that leaves you sitting silently at the kitchen table. One homeowner in Conifer, Colorado, described a renewal shock where the premium jumped 165%, from about $3,200 to $8,500 a year. You think you have prepared for the worst-case scenario. Then the system sends you a worse one. At that point, the house starts to feel like a financial prison. Staying means the premium squeezes the budget. Selling is not simple, because the next buyer also needs insurance to get a mortgage. You are playing a game where the rules were rewritten after you bet your life on the board. The mortgage was not the final price, it was the entrance fee. Do not panic. But do not treat insurance like a small line hidden inside escrow either. You cannot fix the insurance market by yourself. John and Sarah cannot make wildfire maps, reinsurance costs, or mortgage rules disappear with one phone call. So the answer is not just try harder. The answer is to change what you check before you believe you can afford the house. Do not only ask, can I afford the mortgage? Ask, if the insurance market walks away, can I still afford this house? Get the quote early, before you fall in love with the kitchen and the backyard. Do not only ask, am I insured? Ask, who is this policy really protecting? Is it full homeowners insurance? Or a fair plan policy plus DIC? If insurance moves through escrow, read the statement. Look at the new monthly payment. Ask the lender ahead of time. If the policy gets canceled, how would force-placed insurance work? When that letter is sitting on the kitchen table, you are negotiating with the terms of the loan, not with the dream. In the new housing market, the question is not only whether you can afford to buy the home. The question is whether you can afford to hold the risk that comes with it. That is why this trap changes the meaning of the word home. In the end, John and Sarah did not just learn that home insurance got more expensive. They learned something colder. The house is no longer only a place where you live. It is a risk profile being read by the bank, the insurer, the state plan, and the global reinsurance market. Homeownership used to be sold as an arrival point, keys in your hand, a child's room down the hall. The feeling that you finally had a place to stand. But in this trap, the keys are not the ending. They only open the door to the next bill. Last resort insurance sounds like a life raft. But sometimes it is a signal that the private market has looked at your house and said, this risk is no longer worth holding. From that moment on, the mortgage is not the final price. It is only the ticket in. You can pay on time, you can avoid claims, you can take care of the house. You can protect your credit score. But one thin letter in the mailbox can still make you ask, if the cost of staying is no longer something you control, what do you really own? They did not just buy a house. They bought a risk the market no longer wanted to hold. And the story does not stop with the home. If insurance can reprice your house using your zip code and wildfire risk, the next version of the trap gets even closer to your daily life. Your car. Your car knows where you went, how fast you drove, how hard you braked. And when you came home, the car used to be a symbol of American freedom. But if it is telling your habits to a pricing system, the final question is this: who is your smart car really smart for?